everyone. In the last video, we talked about the most wild and brutal week in the US stock market history. Today, we're going to talk about the history of the circuit breaker and its revolution. In the past, US market doesn't have a circuit breaker mechanism. For example, there are more than 3 times the market crashed 9% or higher in 1929 market crash, the Great Depression. In 1934, the ICC was created to regulate the market. But for many years after that, there's no such magnitude of single-day drop. So they didn't even seriously think about a circuit breaker rule. It's kind of like if there's no virus at all or this coronavirus thing, most people will never think about buying a face mask, right? And now times comes to October 1987. We call that Black Monday. On that day, the US market dropped more than 20% and triggered a global market crash. Although it has passed 33 years, it is still the #1 single-day drop in the US market history. It has a huge shaded area in most of the professional investors' hearts. I still see a lot of people can say at least two dates of the market. One is the March 9, 2009, the beginning of the bull market, and the other is October 19, 1987. That is the big crash, the Black Monday. There are many things we can say about this 1987 market crash. We're going to say a little bit the most relevant thing today. Actually, before that, in September 1986 and the January of 1987, we already see a few smaller magnitude of market crash. But people are so optimistic at the time, and after each flash crash, the market resumed going up. So most people didn't pay attention to that. It was the age of Apple, Microsoft, and IBM. A lot of financial institutions start to think about using computers to analyze the big data and try to find a pattern and use the computer to trade. Of course, computer never get tired, never get exhausted, and much faster than a human being. At the beginning, for people who do finance, they don't know how to program, and for people who do programming, they don't know finance. And with the rise of this computer algorithm trading, a lot of financial institutions start to hire either PhD from math department or from physics department. James Simmons, the great mathematician, after he won the highest level of medal in geometry, he started his hedge fund firm in 1982. Started to use a mathematician's insight and the skill set of computer scientists. It was a great story. We're going to talk about that later, probably another day. Obviously, computer algorithm trading has a lot of advantages, but it also has some weakness. The biggest problem with computer algorithm trading is it was written, the code was written by human, and those code often reflect a similar logic. So when people are using a similar logic to trade, it has a problem. For example, when people are using this trending, the moving average, when the short-term trend is crossing the long-term trend, we call that gold cross. Other way, long-term trends cross the short-term trend. The short-term trend cross the long-term trend from the upside down is the dead cross. So when the market going up, it was good. Everyone is gaining. But when the market is going down, it will quickly make the volatility much, much bigger than it should be. Because, for example, for the dead cross, a lot of the trading signals will be triggered. And because computer is so fast, just in a very blink time, all of the selling pressure will flood out, like the floodgate is opened, right? And more selling pressure, the price will be lower, and that will trigger more selling signals. So a lot of the selling pressure and selling signals, and all of this transaction will flood into the market. It's just bigger, faster, stronger than human being. This is the problem that happened in 1987. That was the rise of this computer algorithm trading, the beginning of that. And when everyone is looking at the good part of that, is driving this market higher and higher, we forget about the risk, how to control the risk, how to hedge the risk. For many years, when people are talking about Black Monday, everyone knows you are talking about Black Monday of 1987. Now, we often have to say it's the 1987's Black Monday. The reason for that is there are many more Black Monday comes after that. And that includes the Black Monday of last Monday, March 9, 2020, and this Monday, March 16, 2020. I don't even remember there's any other case. 2 Black Monday happened in 1 year, and even the same month of 1 year. So from now on, whenever we say Black Monday, we'll probably have to refer to a specific date. Which date Black Monday you are talking about? We have to say that although this crash can happen on any trading day, such as the Black Thursday of last week, but we see more, or at least more than half of the crash happen on Monday, or we call that Black Mondays, because for the other day, the previous day is also trading day. So the information has been digested by the market. But for Monday, the previous trading day is last Friday. Therefore, the market has to digest the whole information since last Friday. And that is making Monday much more volatile. For similar reasons, on Friday, because investors are facing some uncertainty in the weekend, so if there's something big could happen, many people will get out on Friday, and that will cause a lot of volatility on Friday. But there are several other reasons that caused the 1987 Black Monday, but we'll leave that for another day. The consensus is this is a technical driven market crash. It's not fundamental driven one. The truth is the 1987 Black Monday moves very fast, goes quickly away. The US economy didn't go into recession. The stock market resumed going even higher and higher, march higher and higher, make another all-time high. But after this Black Monday in 1987, SEC started to consider about the circuit breaker rule and was implemented at the beginning of 1988. We can see that this circuit breaker rule initially was designed for this type of non-fundamentally driven crash. Using those polls, we can give people a time to calm down, to adjust your trading algorithm, your code. And that partially explains why this time, when the crash is not only driven by technical thing, but also by the fundamental thing, because of the coronavirus, we are seeing 4 circuit breaker in just 8 days. Although the circuit breaker rule was in place since 1988, it wasn't used for almost 10 years. Until October 27, 1987. It's another Monday. We call that Black Monday. That Black Monday is a Bloody Monday. To give that a different name so we can distinguish that. But after that, because there are more and more Black Monday, so people get tired of name each one of them, so we just call them Black Monday. But for this one, we have a name, it's Bloody Monday. It's the first time the market triggered circuit breaker. At the time, the circuit breaker is still associated with the Dow Jones index. It was not with the percentage drop, it was the point drop. On that day, the market triggered circuit breaker twice. The first time Dow Jones dropped 350 points, it triggered the first level circuit breaker. The market was halted for half an hour. And then once the market resumed, it further dropped by 550 points and triggered the second level. The whole day was canceled out. 550 points drop is only 7.2% drop. It was much lower magnitude than what we are seeing in these 2 weeks. Since the Bloody Monday on 1997, SEC started to redesign the circuit breaker again. First of all, they changed that from the point drop to percentage drop. For example, when the Dow dropped 10%, the market will be holding for an hour. The other trigger point is 20%, 30%. The larger is the magnitude, the longer the market will be holding. In the following years, SEC make some minor adjustment to the circuit breaker. The most recent one is after the flash crash in 2010. In May the 6th, 2010, a Black Thursday. Although the backdrop is UK has the election and Greek has the debt crisis, but there's no major negative event on that day. In the afternoon, in a few short minutes, Dow Jones just dropped 1,000 points, almost 10%. In the worst 5 minutes, Dow Jones dropped 600 points in just 5 minutes, including Procter & Gamble. They lose hugely during that 5 minutes. But because at the time, the circuit breaker is still triggered by that 10%, and this is a little bit lower than 10%. So the market is not halted, it just continues on. Seriously, for a few minutes, the market rebounded, and just like nothing happened. And that's why we call that a flash crash. There are many different explanations about this flash crash, and we're going to talk about that in another day. But the consensus of the market is, again, it was because of the computer algorithm trading. The difference is, after so many years, the algorithm trading has become more advanced. Now it's high-frequency trading. In a quick period of time, before you blink your eyes, there are thousands of, 10,000s of trades. And it's also associated with more complicated derivative market. In 2016, a UK trader, Navider Sarro, he was accused to be responsible for the flash crash in 2010. The Sarro said he thinks the market is like a super complicated computer game. He used a computer algorithm trading to place huge amount of selling position, but not a real selling position. He's using that to move the market, but he quickly withdraw all of the selling position, so that is not implemented, but enough to move the market down. So essentially, he's saying, I'm going to sell all of this, and then very quickly say, no, I'm not selling that. But the other people already see the selling pressure, all of the selling position, so the market has already reflect by the huge selling pressure, right? The price is down, but he's withdrawing all of the position. He's not doing that, but he's taking advantage of it. In the morning, he started to place the faked selling position. When the trend is formed, he started to sell even more and become more crazy around the lunchtime, and that is causing this flash crash. After the market crashed, he buy at the dip, a very low price, and after it rebounded, he got about $900,000 in just one single day. The U.S. Department of Justice said he probably got almost $40 million from 2010 and to 2014 by just trading like this. After this flash crash in 2010, SEC again adjust this circuit breaker rule, and this changed to the 7%, 13%, and 20% rule. It was also associated with the other market index like SP 500. So that was the history and the change of the circuit breaker in the history. Of course, there's also a mechanism about individual stock circuit breaker and the circuit breaker or limit up and limit down for the futures or index futures market, but that's for another day. That's all for today. Thanks for your attention. We'll see you next time.